Hey, it's Andy. Just wanted to pop out a quick video to just cover a couple of things that are going on this week. It's a big week for central banks. There's a wide range of them hitting the markets this week, and so we're going to have to keep a really close eye on it. A lot going on. Obviously, the Federal Reserve is the biggest one, and so there's a lot of focus on the Fed Fund futures rate and what they're pricing in for 2021, 2022, and 2023. Just try to keep in mind that these are just expectations, right? And not only you can look at these as expectations, but also the dot plots for the Federal Reserve as well when they put out their predictions of what they're going to do. And just really keep that in mind. The Fed can say whatever they want right now, and they'll try to keep the market calm about whether or not they believe they're going to raise rates in the future. But the bottom line is this, is that as the data comes in and the U.S. GDP heats up significantly after the $1.9 trillion stimulus plan gets into the pipeline here, they're going to be under pressure. And there's a lot of pressure building with inflation. If you look at the NFIB numbers, you'll see that I think it's like the fastest expectations for what's happening with inflation in that National Federation of Independent Businesses surveys. So there's stuff building in the pipeline. Now, we did see the U.S. 10-year Treasury note rise to about 1.62 last week. It dropped off a little bit to start this week, but it'll probably stay around those levels. So we're going to start to see some pressure on interest rates going up. And that's what we're going to look at to see what the Fed comes up with this week. There's, obviously we'll see what they say. We'll see about also what their change in their predictions for what GDP are going to be this year, especially with the stimulus plan that's pushing through right now. So just try to keep that in mind. The Fed may talk like they're not going to do anything, but they're going to be forced to do something by the markets eventually as we continue to get much faster growth and obviously commensurate inflation pressures as well. So you really want to keep an eye on that. And you'll probably see this inverse relationship between interest rates and tech, right? Tech has been super speculative. And it's come off significantly since we started seeing the rise in rates over the last month. But we've also seen a lot of a rotation out of tech into the kind of underappreciated stocks, shall we say. So that's something that I think we'll keep an eye on. We'll see if that can continue to push up the S&P and the Dow. And of course, the Russell 2000 or Russell 5000 stock index. And I just want to wrap this up by looking at SPACs, which are just kind of a favorite area for me. There's a lot of interesting things that are going on there. As I warned about certain stocks, finally actually having to come forward with guidance on what they think for their earnings and revenues and sales. That's where the rubber meets the road for a lot of these SPACs. And I just go back to Muddy Waters, which is one of the most renowned short sellers. And Carson Block came out and said, I want to get the language, SPACs are an area of focus, as they should be, because they've gone crazy. And I think right now there's something like about $2.8 billion worth of shorts against SPACs. Now, it's not that insane. It's not like a GameStop situation, but I do think that those are starting to build. Now, it's smart money to some extent, a lot of hedge funds and things like that. But to me, it's an opportunity as well, because I think these things are just so overdone right now. It really reminds me of maybe the ICOs at one point back in 2019 and 2018, where they really got out of control with the speculation on those. And the fact that Bitcoin is around 60,000, I mean, there's some value there for sure. It just depends on your time horizon, but just be really careful with these extra speculative stocks. Now, having said all that, here's what I think too. Let's elongate the view out here. Let's look beyond the here and now to what's coming. So we're looking at extraordinarily rapid growth for the first, second, and maybe even third quarter of this year. So that's going to propel interest rates higher. It's going to propel inflation higher, but it's obviously going to propel economic growth. And so that's the question going on from here. Like, where do we go from here? So from that standpoint, I think we can see significant growth beyond this year into 2022. So it's not a one and done thing. We've just had so much excess buildup in the markets right now that I think we're at kind of a flipping point where we're going to spend some time backfilling, and that's what I'm seeing. And it really depends on how far up, obviously, interest rates go and inflation. But for the short time or the short term, that's a problem. Longer term, I think it's okay. I definitely think we're bubbling in the housing market. I mean, it's hard not to think that when you see prices in Arizona and North Carolina shoot up something like 40% in different pockets just over the last 2 years. But I also think that we're seeing a migratory shift from when we used to see it from the south to the north. Now we're seeing it from the north to the south. And states like Arizona, Texas, North Carolina, and Florida are all benefiting. I don't expect that to change over the next 5 years. I expect that to continue for a long time. And just remember, it's not work from home anymore. It's work from anywhere. So when you have that in your mind and start thinking beyond today and why these prices are going up, they may not stop going up for some time, especially in a very low interest rate environment as we see those migratory shifts occur. All right, that's it for me, Andy Bush. If you like these videos, click on the button subscribe. If you want to get more right away, just click on the picture below and you can get those, and you can get all of my research at andrewbush.com. Thanks for watching.